Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon. And in previous couple sessions, we talked about probability of success. We also talked about return on capital and reward. So in this session, I'd like to talk about our next topic. So let's take a look at how to select the right option strategy. Selecting the right option strategy is very important to be a successful trader. You have to know the direction of the market and direction of the stock. You have to be comfortable with stock or underlying asset that you're trading. You have to learn how Twitter or Facebook or oil trades from one cycle to another. And then the third step, once you know which stocks to trade, and once you know what is the direction of these stocks, you got to figure out what is the most optimal strategy that gives you highest probability of success. So strategy that gives you the highest cost basis reduction, statistically speaking, gives you the highest probability of success. So the further away you are selling your strikes, where the underlying stock is trading, the higher probability of success, the better the strategy is. So buying puts and calls is probably one of the lowest probability of success strategy, and probably one of the reasons why most option traders, when they begin trading options in the beginning, they lose money. Because they are buying puts and calls, especially when implied volatility is elevated, and they're paying too much premium for these puts and calls, and this yields a probability of success less than 50%, meaning that you're better off trading stock because you're actually buying options, and the stock has to move toward your strike price. Selling naked puts and calls is the opposite. That gives you a highest probability of success. It's also higher risk, but it gives you best results when there is a lot of uncertainty in the market. When implied volatility in relative terms is high, selling naked puts and calls makes sense because you're getting a lot of premium for your options. But they present a lot of risk. So what can you find somewhere in the middle? Vertical spreads, calendars, condors are more conservative strategies that give you highest probability of success, but the lowest amount of risk, because you are capping your maximum risk, but you're also capping your maximum gain. So how do you select the right strategy? In the beginning, you take more conservative approach. As you get more experience with understanding of probability of success and how to defend your positions aggressively, and you want to take emotions out of the equation, then you start doing more complicated strategies like cover calls, spreads, or iron condors. If you go to Tradespoon, we have tools that you can see on your screen, Trade Builder, where you can type in a ticker. You can type in your time horizon, you can type in how much money you want to invest and what probability of success you want, and we'll give you what are the most optimal strategy that gives you the highest probability of any profit. And you can see it on your screen. So by reducing your cost basis, that is the most optimal strategy. So if you do a call spread, if you sell, let's say, a call spread, you can also sell a put spread if you think that the stock will trade in a range, and that gives you higher probability of success because you're collecting more premium and hence increasing the probability of success. You can find out more information on how to find the most optimal option strategy based on the market condition by visiting our webinars. We have a webinar next week, tradespoon.com webinars. And always stay in touch on social media. Thank you.